And so what they're telling you, in my opinion, is that they're playing chicken with the economy and the Fed and hoping that the Fed starts to lower rates, the economy turns down between now and the time that that runway runs out, which when that happens, I'm going to say it's going to happen by the first quarter, but we have to see.
Markets had an unexpected boost last week as the Treasury became less aggressive in auctioning off its assets. We're going to be talking about bonds, equities, and Bitcoin with our next guest, James Lavish, who is the co-managing partner of the Bitcoin Opportunity Fund and also the author of the Informationist newsletter. We'll be talking about some of his work there as well. James has spent many decades working on Wall Street on the institutional buy side. Welcome to the show, James.
Thank you for having me, David. Glad to be here.
Give us a 1 minute synopsis of your career leading up to working now in the crypto space.
Yeah, so for the viewers that don't know me, I started out on the floor of the New York Stock Exchange. I was a hockey player and I got injured, as you and I were talking about a little bit before the show. I was expecting to go to the NHL, and that didn't happen. I got injured, and so I went to the floor of the stock exchange, like anybody would out of university, right? So I had bills and I had to get them paid, and I was fortunate to get a job as a clerk down there. So I worked there and traded something called ADR arbitrage, and that's where you buy and sell ADRs, American Depository Receipts, that are foreign shares that trade on the exchange. But that in and of itself just launched my career into being in institutional investing, because it led me to be hired by hedge funds. So I started working in hedge funds as an arbitrage investor in merger arbitrage and risk arbitrage and doing a lot of risk management. And so that's where I've been primarily ever since in institutional investing in hedge funds and private equity.
Mm-hmm. I would like to ask you about institutional investing towards the end, but first let's talk about the market. So big move in the bond markets last week. The 10-year yield dropped from nearly 5% as of the 31st of October down to as low as 4.5% on Friday. And just today on Monday, as we're speaking, it's ticked up again back to 4.64. What's happening with this volatility?
Well, I mean, if you've been watching the bonds, and especially the long end, the long duration securities, you've noticed that the yields have risen quite a bit over the last number of weeks, leading into last week. And really, the issue there is the Treasury has issued so much debt in the last few months. They have issued over $2 trillion of debt in 5 months, and they issued $600 billion of debt in just a few weeks. And it began to spook the markets, and the markets they have this delusion. There's tsunami of debt that's coming from the Treasury, and they're wondering, well, how much debt is really going to come? They're looking at the deficits, and so the long end of the curve started to tick up in the yields. And so the issue here is that there were a lot of trades that were looking for that to blow out even further as we see the deficits grow and it kind of get out of control. So last week, what happened was the market was, instead of being keyed in on the Fed and Jerome Powell and his announcement of the rates and whether or not they had any activity there, and his press conference, they were keyed in on the Treasury and their refunding for the fourth quarter. And so the Treasury came out and they kind of calmed the market and said, okay, look, we're not going to issue as much as you think we are in the long end, so anything from 2-year, 10-year, 20-year, 30-year, like we're going to keep that a little bit lower than the market expects. And the market ate it up, and they said, okay, great. So it sounds like they have it under control. Spending is under control. The Treasury has visibility that we can trust that the rates are not going to spin out of control. So we can start buying the long end of the curve. And then when Jerome Powell did come out, and he reinforced that narrative by saying that, look, we didn't think about raising rates. We're not thinking about lowering them yet. They're right where they are, right where they should be. And we're going to watch, but we have seen that some of our rate rate hikes are having an impact, and the higher rates from that long end of the Treasury curve are having impacts. And what does your mind go to? The mortgage rates. And they're seeing that it's starting to have an impact in the economy, which we've seen a rise in unemployment, a rise or weaker PMI numbers. So it led to this short euphoria for the markets. Say, oh, we can buy bonds, we can buy risk assets because the Fed's probably done raising rates. And so that's kind of what happened last week.
Last week, the Treasury also announced that they would sell $112 billion of longer-term securities at its so-called quarterly refunding auctions. So this selling of assets, is that part, just to clarify, that's part of the quantitative tightening program?
Well, yeah, they're trying to let these securities they have on their books kind of roll off, right? So just let them mature best they can. And if they can sell them and not compete with the Treasury for liquidity, then they're going to continue to do that. But here's the funny thing, David, and this is what I was talking about this morning on a different show. The issue here is that the Treasury kind of buried two statements in their release. And one of the statements was they have the right to change the amount of debt that they're going to actually end up floating this quarter. So they can change that. That's one thing. Okay. And so even though they gave this estimate, they can change it as we get closer to those auctions, and they can raise the amount that they're going to issue. So that's one thing. The second thing that they said was we're nearing completing our bond buyback program, which is going to be instituted in 2024. Well, what is that? Well, the bond buyback program it's none other than it's yield curve control, where the Treasury will go out and buy bonds that are called, they're called off the run securities. Well, back in the day, I'm a lot older than you, David. When I first walked onto a bond trading desk, these big guys, they're all the bond traders. They'd have these reams of paper. They were like this thick. And there were those white dot matrix paper that would print out every single day. That was the printout of all the bonds that were kind of in the market. Well, if you got a call from an investor and that bond wasn't in that list, if you couldn't find it in there, it was called off the run, which means that it was not very liquid. It doesn't trade very much, so you didn't know where to trade it, and it had a lot of flexibility in the pricing. Well, that's what they're talking about doing, is finding those bonds that we don't use paper anymore, but they know what is off the run. Well, this is old paper. This is long dated paper that has a long way to maturity that they're talking about buying. And, they're going to do it at prices that are closer to market prices, if not better than market prices, in order to maintain the market price of the securities. And that's called yield curve control. And, it's just something that as an investor, you have to remember that this is what's most important to the Treasury right now, is managing how much they have to float at what interest rate in order to keep that deficit as low as they can, because they're part of driving the deficit with their interest expense. And that's part of the problem. And so you can tell that they are very concerned with the long end of the curve and just where those prices went. And it was a little, you can tell from their release that they're concerned about that.
And the yield curve control you were talking about, that's implemented to target a certain interest rate right now?
Well, we don't know what it'll be, but I can tell you right now, they're not comfortable with interest rates in the long end going over 5%. They made that clear last week from that announcement and from that release.
Are they signaling then rate cuts with that announcement?
So the question is, is the Fed signaling rate cut? Well, the market certainly took it as though the Fed is done raising rates, and you could see it from Fed futures. But what the market is saying, I think the market went a little bit too far and said they're going to start lowering rates in the first quarter, in January, February. And so if you look at the probabilities that, you're seeing a probability of like a 30% probability of a rate cut by March, right? So that, to me, it's a little bit aggressive. Now, that said, I can see the Fed having to cut rates soon if we do, in fact, tumble into a recession, which I fully expect we will. So that's the question. And so getting to your point, it seems like the Treasury is just playing chicken with the market. Well, how are they doing that? Well, they know that they can issue short-dated paper. They can issue up to $1 trillion of short-dated paper without a problem right now, because there's $1 trillion still left in the reverse repo facility. The reverse repo facility is excess capital that's from large banks that's parked at the Fed, gaining an interest rate, right? It's yielding return for them. But the Treasury is kind of teasing that out because they're issuing paper that's just a little bit better rate than that. And it's short-term paper. So they're getting money out of it. You've seen the reverse repo facility drop from 2.6 trillion down to just under 1.1 now. So now there's $1 trillion left that they can use on the short end. Now, they reiterated that they're comfortable with having a very large percentage, over 20% in T-bills and short notes. So that's uncharacteristic in a situation we don't have an emergency, where we don't have disruption in the markets, but they're comfortable with that. And so what they're telling you, in my opinion, is that they're playing chicken with the economy and the Fed and hoping that the Fed starts to lower rates, the economy turns down between now and the time that runway runs out, which when that happens, I'm going to say it's going to happen by the first quarter, but we have to see.
So you're saying recession is going to happen by the first quarter?
Well, the runway of using up that reverse repo, that's going to run out in the first quarter. And I would be surprised if we're not seeing real signs of recession by the first quarter.
No doubt you've noticed that the 10-year minus 2-year yield curve has started to reinvert back to zero. Well, it hasn't just started. This trend happened earlier in the year. It was negative for more than a year, and then now it's almost back to zero. What does this signal to you?
Well, I mean, every time that the yield curve, the 2 and 10-year yield curve inverts, and for your listeners, what we mean by that is when you look at the yield of the 10-year and you look at the yield of the 2-year, if the 10-year yield is lower than the 2-year, that's called an inversion. You should be getting a better return for your money the further you go out in time. But if it's inverted, that means that people expect rates to come down. Well, it inverted last year, so it's been inverted for a long time. And so, but every single time that inverts, you do have a recession after that. Now, we don't know when. It's typically somewhere around 12 to 24 months, 18 to 24 months, but you don't know exactly when. Now, what you're saying is that, yeah, it's uninverting. But part of that is because the long end of the curve has been pushed up so steeply. The yields have been pushed up so steeply by those bond vigilantes who want more return just in case the Treasury dumps more bonds on them. So it's hard to say if that is more indicative of timing of the recession happening, but it is an indication, because once it uninverts, the recession happens after that. So it inverts, and it comes out of uninversion, uninverts, and then the recession happens. That's typically what happens.
The S&P 500 has gained back most of its losses, if not all its losses, throughout October. What was that a response to? Was that reacting to, there was kind of a perfect negative correlation with the 10-year yield for quite some time, and then both kind of fell together in tandem late October. So I'm curious.
It's unfortunately a perverse reaction from Wall Street, right? It is when people are worried, investors are worried that the Fed is going to continue raising rates, which means that it's going to continue raising. It's raising the cost of capital for all of these companies, which decreases their margins, which means that the price has to come down. or their earnings have to go up. There's no way that the price should stay the same in the market unless that one of those two things happen. So the price has to come down in order to to reflect that. But if people think the Fed is done raising rates, well, that gives them runway to say, well, then all else being equal, if we have a soft landing and we don't go into a recession, then stocks are a buy here because the cost of capital isn't going up, and we should be, we should be, all things being equal, it signals that the market is underpriced. Now, the reality is that when the Fed stops raising rates, that's when the recession happens, because the Fed is backwards looking. They've admitted this. They talk about it. They know that they're looking at information that is weeks, sometimes months old. It's stale, and these are slow, massive moving ships that they're trying to gauge exactly what direction they're going and how quickly. And it's really difficult. So the reality is that the market rallied off of information that the Fed is saying, well, the economy is starting to slow down, so we're going to stop raising rates. And perversely, the market rallied off of that because they said, oh, well, the rates are not going to go any higher, so that's good for stocks. But to me, it's kind of a bear rally, is that it's a little bit of a hope that we have this soft landing rather than the reality of going into recession.
Certainly, when you see a rally, you think the markets aren't pricing in any sort of weakness in earnings this season, or perhaps they're not even factoring in the fact that unemployment just went up to 3.9%, which really isn't great for the economy if you expect this to go any higher, right? So either they think this is going to be short-lived, or they think that this is really not going to be a problem.
Exactly, and again, the reality is that if you look back at recessions that occur in the modern financial era, if you look back at when unemployment begins, well, it starts to tick up a little bit, and then we hit a recession, and then it spikes every single time. I mean, it explodes higher every single recession. This is what happens, and it seems like investors forget this, and they think, well, maybe it's just ticking up and it'll come back down, and we have that soft landing. But low unemployment is not indicative of us not heading into recession. It's a bad indicator. It takes a little while for that to happen, and then you have mass layoffs, and it happens over and over and over again. So I just caution people to be careful. Looking at unemployment is not a great indicator.
Generally, which is better at predicting economic growth or contraction, the bond markets or the equity markets?
Bond markets every single time.
Okay. All right.
If you're a serious investor, you should be looking at the bond market.
And so what have the bond, just to summarize, what have the bond markets been signaling when it comes to growth over the last 6 months or so?
Yeah, so you could see it from the inverted yield curve. They were so inverted. That is what the bond market has been signaling for a very long time, right? So that's the one thing that people have been looking at, how yields further out on the curve are lower than yields that are close in. And so people have been staying in cash. It's the right thing to do if you're an investor to stay diversified, is take advantage of those high earning cash yields, because it's only 5%. I mean, it's not great, but it's way better than we had during zero interest rate policy. So when you see those yields that are much lower out on the curve, that signals that the bond market believes that we're headed for a recession.
Do you have a theory or explanation as to why bond markets have been historically more accurate when it comes to pricing in forward-looking risks for the economy?
Yeah, I mean, well, bonds are first claim on assets, right? So they're worried. They're most worried about trips and covenants, about slowdown in earnings, that companies can't meet their obligations. The equity is levered to the returns of a company. It's the ownership of the company that's last on the ladder. And so the bond market is very keyed into the health of companies and the health of sovereigns and the health of the economy, because that's how bonds are priced.
Turning now to your work on debt levels. So you've written a number of reports and you've discussed this extensively, the issue of the rising debt levels in the United States. In fact, you tweeted about this just over the weekend. You said that the US ended the week with $33.7 trillion of federal debt and $211.2 trillion of unfunded liabilities, bringing the total amount owed to $245 trillion. That's approximately 55x tax revenues, or the equivalent of someone with a 100K salary and $5.5 million of debt. How sustainable are these levels for debt for the United States is my question. First of all, okay, I understand your comparison, and it's ridiculous if you have $5 million of debt with a 100K salary, but I can't print money, right? As an individual,
Exactly.
I can't just.
And that's okay. So that's great. And that's a really good point. But the point of that post, of that tweet, is to get people to understand just the magnitude of the difference in earnings versus debt that we're standing on in the US government. But the important thing that you just said, that's the most important part, is that we can print money, and we will. We just talked about it, about yield curve control. That is literally printing money. So that's what they're looking to do, is to flood the market with liquidity to make sure that treasury market always stays liquid. If the treasury market becomes illiquid, or it becomes dysfunctional, and they have difficulties with issuing certain bonds, that's catastrophic to the financial community.
Wait, sorry, back up. Why would it become illiquid?
Well, if they crowd out the marginal buyer because they're issuing so much debt, if you just can't find enough buyers at the right price for an auction, and it becomes dysfunctional, that's a problem, right? So we've seen this happen we've never had the bond market go illiquid, the treasury market go illiquid, but we have seen instances like back in March of 2020 where it locked up, where they were not sure just how much they can issue. So they have to print money in order to go in and keep it going. Okay. But the point of all of that is, when you have so much debt that you're paying so much in interest, and that deficit is just growing, it's a debt spiral. Why does that happen? Well, you just go through the numbers that we have right now. Okay. So the US took in about $4.4 trillion of revenues last year. That's taxes. That's our productivity, right? So, but they spent $6.1 trillion. So do the math out. That's $1.7 trillion of deficit. So it's actually $2 trillion when you add back in that student loan forgiveness, which is just an accounting adjustment from year to year. It was really $2 trillion of deficit last year. So and $1 trillion of that on a run rate is going to be interest expense from all of this debt. So what happens is, because we are running on a deficit, as bonds mature, we have to pay down that bond. We have to give the principal back, but we don't have the principal. We're running a deficit. So how do we give the principal back? We issue more debt. And now that debt in the last couple of years is now at a 5% rate, when it used to be at a 0.5% rate to 1.5% rate. And so we're paying that much more in interest. That interest expense grows. And so the need to issue more debt grows, and it's just a debt spiral, right? So even the Treasury admitted this last year. So they put out regular reports about the health of the Treasury and what's going on. And this is the Treasury. Now, remember, the Treasury is not the one deciding the spending. The Treasury is the one who's managing all that spending from Congress. So the Treasury put out a report that was titled the State of the Treasury. And then underneath that, the subtitle was An Unsustainable Fiscal Path. And it showed the debt growing exponentially versus GDP and showing how it was going to go from 120% GDP all the way up to 200, 300% GDP over the next 30, 40 years, because they're trying to signal to Congress that you have to stop spending because we can't keep up. Okay, this is a long way of answering your question, but it comes down to, what can the government do? We're spending so much money. Our deficits are so large. What can they do? They have three choices. You can either have austerity, fiscal austerity, which is cutting programs. Well, the vast majority of what we spend is on entitlements. It's Social Security, it's Medicare, Medicaid, it's spending on unemployment and helping people when they need checks for for stimulus, and it's veteran stuff. But these are all signed into legislation. You cannot change these unless you change the legislation. That's number one. That's your first big entitlement. That's your first big mandatory expense. Your second one is the military. It's not mandatory, but you're not going to not spend on the military. You've got these long-standing, deep contracts with these huge contractors, these defense contractors. You're paying those. And then the last thing is your interest expense. Well, you must pay your interest expense or you default. And the US will never default. No country that can print their own money will default. Put a pin in that, hold that there for a second. The second thing they can do is raise taxes. Well, we've seen in countless examples that when you raise taxes, it ends up disincentivizing and lowering the productivity of companies, because the companies can't reinvest in research and development, in hiring people and generating more productivity. And so you end up getting to the same spot because GDP lowers and the taxes are higher and you get at the same place. And so that doesn't really work. Well, the third thing they can do is issue more debt. And they just issue more debt and borrow more, which is the easiest path. And that's what they're doing. Now, to get to exactly what you said, which is the money printer. So what is the last thing they can do? As this debt spirals out of control, what can they do in order to rein that back in, make sure they pull those deficits down? Well, they can print more money. They can inflate the currency, inflate GDP. So it's the nominal GDP goes higher, inflated, not being inflation adjusted, just the dollars. There's more GDP, there's more productivity, there's more dollars in the system, and that goes up, right? So as GDP goes up in nominal terms, they can tax that and the tax revenue will go higher. And so they'll be able to pay down some of that debt that they issued years ago with cheaper dollars. And that's the plan. So if you look at our CPI numbers and the inflation numbers that they report, they pull out a lot of stuff that is pretty important. Things like housing and energy and food. And they have this core number that they say that they look at and they report that. They'll report the whole number, but they focus in on this core number and say, well, inflation is coming down, it's getting under control. But the reality is, if you go out there and you talk to anybody either in Canada, in the United States, prices have not come down. They still are going up, and they're going up more than they're admitting to. And there's some funny business going on with the BLS, the Bureau of Labor Services, and how they calculate CPI. It's not precise. And so the plan is to continue to allow inflation to be high and structural perpetually in order to bring down the pace at which they're issuing debt. And so what's the answer? How do you get around that as an investor, as just a normal person? Well, you have to own assets in order to keep up with that inflation. Unless you have a boss or a company that raises your wages at or above the rate of inflation every single year, you're going to fall behind. And so how do you keep up with that? You own things like hard assets, hard monies like gold, silver, Bitcoin, because they, especially Bitcoin, cannot be inflated like the US dollar or all the other currencies around the world. And that's the big difference.
All right, we'll talk about Bitcoin just a bit. I do want to push back slightly on gold and silver. Yes, they've been perceived as inflation hedges, but the inflation-adjusted real price of silver hasn't moved in the last 40 years. The nominal value of gold hasn't moved in the last 10 years, and over the last 40 years, it's underperformed the S&P. If you just look at the price charts, do you still think that they're good inflation hedges in the long term?
Yeah, I do believe that gold in particular is. I believe that silver can be, and it'd be better for if you look around the world, okay, not just US dollars, it's better to hold silver than it would be, and it's easier to get silver than it would be to get gold and sometimes Bitcoin. But if you're in one of these areas that is experiencing high inflation, whether you're in Argentina, you're in Venezuela, you're in Lebanon, you need a way to get your earnings into something that's not inflating away from you. Okay, so that is important for these. So we're often so US and North America centric that we forget that our inflation, as bad as it has been, is nowhere near as bad as it is in other areas. So these are important things for people who are not here. I do believe gold is going to be a really strong hedge over the next period. But I do believe also deeply that none of them can touch Bitcoin, and Bitcoin will be the best hedge by far. And I don't even want to call it really a hedge. It's a place to put your real earnings in and save them without being inflated away. And that's the most important thing.
What's the time horizon you have to utilize in order to realize the value with wealth preservation aspect of Bitcoin? Because if you're short term, let's say 6 to 12 months, well, we know you've lost money over the last 12 months or so if you bought in 10 years ago, obviously you beat everything, right? So I think time horizon matters.
Well, over the last 12, I think you can look at the charts of Bitcoin. It is super volatile. So I don't ever well, okay. So we have to look at where you are. If you're in a place like Venezuela or Argentina, it may have been very valuable for you to be in Bitcoin, okay, depending on when you bought in. And if you're here in North America, if you're in the US or Canada, and you have a lot of cash, well, part of your strategy, which should probably be, and everybody's different, so everybody has to do their own investment research and work with their own manager. But if you have a lot of cash, parking in short-term treasuries, they're not going to default on those, and you're going to get some sort of yield on that. You can park some there waiting for opportunities as volatility comes. And if we have some sort of credit event where all assets correlate to one, and you have a V drop, a drawdown, well, that gives you an opportunity to add to those exposures. But to your point, Bitcoin, I would not put all of my excess cash in Bitcoin because it's too volatile. And that is why I also own gold. I know that gold, as volatile as it has been, it's nowhere near the volatility of Bitcoin. So you can actually have a stable asset there, and it will protect value over time. And even though it won't be in 10 years the same kind of protection as Bitcoin will be, it will be better than having US dollars, in my opinion.
Okay. Are you concerned about the attitude towards Bitcoin from the US government? Are you concerned about the US government one day potentially following in China's footsteps, which is to ban Bitcoin trading, investing, and mining?
Well, I mean, look, it didn't even work in China, right? So it's hard to tell. The US has had a history of banning hard monies. It banned gold. It seized gold 100 years ago. I do believe that it would be difficult to do the same thing in this day and age. In where we are now, I believe it would be difficult. And just the nature of Bitcoin, it would be difficult. You can't ban Bitcoin across the world. there's tens of thousands of nodes and miners across the world. It's just there's no way that they can just shut it down. So
I guess one thing they could do is raise capital gains taxes on Bitcoin and crypto trading to an exorbitant amount that would disincentivize anybody from actually holding it. I'm just, there are things they could do directly.
They could put forth that legislation. I don't think it would get through. I think we already have enough of a voice that it wouldn't get through. So what you're talking about is important. It is very important for Bitcoin to get some legislation around it where we have some clarity on exactly what the rules are going to be, and it's completely separated from everything else. I think that's very important. I think a huge step toward that is getting these spot ETFs from Fidelity and from BlackRock, because these institutions control over $15 trillion of wealth control. They oversee over $15 trillion of wealth for their investors. And why are they doing this? They're doing it because their investors are demanding it. That's why. They're not doing it because they think they're going to go and buy a bunch for their own balance sheet. They're doing it because their investors are asking for it. They see an opportunity in the market. And I don't believe they would do that without being a very strong voice for a positive resolution around any kind of legislation that was put forward.
What, in your opinion, is the closest competing asset for Bitcoin?
Well, I don't think there's anything that really is that in reality can compete with it. It's been compared to gold quite a bit, but Bitcoin has some facets that gold just couldn't have. It's not easily transferable. Bitcoin is. It's not, it's not easily transportable. Bitcoin is. You memorize your 12 or 24 seed phrase and you can take it anywhere with you in the whole world. You could go to Mars with it. You can't do that with gold. It's very difficult to seize. If you know your phrase, it's difficult to seize. So it just has properties that gold doesn't. I would say it gets compared to it a lot, like it's digital gold, but to me, it's far better.
What about just tech stocks, like the FANG stocks? I bring that up only because the price of Bitcoin has traded closely with the NASDAQ.
Yeah, and I think the reason for that, Dave, and I've thought a lot about this, Bitcoin's a technology. I come from the institutional world, institutional trading world. And I believe that it's become correlated, not recently, but over the last 2 years, up to the last few months, or last month or so, when Bitcoin kind of broke away because of the ETF enthusiasm. But before that, I believe what happened was it's been looked at as like a technology. And so it's kind of grouped into that technology world. And so it is a risk on asset to those investors. That's the way they see it. They see it as a risk on asset. Even though if you truly understand it, you'll understand that it's risk. It's perfectly risk off. It's actually better risk off than even bonds. But the issue is that it's been seen and analyzed and been traded in that world primarily up until now.
James, looking outside the US, some analysts have said that we're entering a multipolar world. First of all, do you agree with this? And if you do, would it make sense to diversify your portfolio into, let's say, emerging markets, equities, or assets?
Well, I mean, if they're talking about BRICS, for instance, I've written about BRICS. I've looked at it. The reality there is, yeah, the BRICS nations want a way away from the dollar. I don't see them as looking for a way to compete with or overcome the dollar. They just want a way to not be beholden to it. Do I see anything else rising to compete with the dollar? No. The dollar is it is a behemoth, and it reaches into almost every single facet of the financial world, between euro dollars, between all of the countries that cannot issue debt in their own currency because there's not enough confidence in that currency. They primarily issue their debt in US dollars. And the U.S. has shown a propensity to make sure that there's U.S. dollars available in order to keep that dominance going. It has been tied very closely, as some people have learned this past year, with oil and energy trade. That's going to be that is changing a little bit, but it's going to be difficult to unseat that completely, and it's going to take a while. So what I do see happening is I see, unfortunately, like Brent Johnson of Santiago Capital talks about quite a bit. I do see, unfortunately, some of these weaker emerging markets and countries and sovereigns that don't have the strength of the dollar getting hurt by this next phase. And if we have a downturn, I can see some hyperinflation across the world, and those currencies just more or less fold into the U.S. dollar and take on the U.S. dollars as their main currency. And that,
you're talking about dollarization happening around the world.
Yeah, I see that as a higher probability than having a polar world. I polarized world. I don't see that as being quite as probable.
You don't think the Chinese yuan will emerge as a competing reserve currency?
I don't think so. I think they have their own problems right now. They have a massive problem with their own debt levels that they won't even really admit to, I don't believe. And they have their real estate market is hinging on a complete collapse. And so they've got issues with demographics. They've got issues with their own structures. I don't see that as happening.
Okay. Finally, let's talk a little bit about your newsletter, the
Informationist,
aptly named the Informationist. Why is it called the Informationist? How did you come up with that name?
That's a great question. So my wife is an author, and she's a novelist, and she's got a good friend who's a novelist that wrote this book that's called The Informationist. Taylor Stevens is the name of the author. It's a great book, and one of my favorite books. It's a character that can speak many languages and learn very, very quickly. And so I kind of it's an homage to her and that series, and that what I wanted to do when I started this newsletter, and I didn't expect it to grow so rapidly. It's taken off like crazy, and I'm very pleased by it. But what I wanted to do, David, was I wanted to give people a peek into how the whole world, this macro world, works. And what winds up happening, often what happens, and I heard this over and over again from people in the space, was I have no idea what that means. I have no idea what that acronym means. And so what I want to do is bridge that gap between just the everyday person that could be very, very smart. I have doctors, I have lawyers, I have some economists, I have dancers, firemen. I've got some nuclear engineers that read this, and it takes whatever concept, whatever financial concept that is important that week, and it simplifies it very simply in about a 8-minute read, and so people can really understand it, and it makes them smarter. And so it's kind of like trying to make them smarter in just a few minutes every single week, and so they can go out and truly understand. When they see the news, they see CNBC, they watch your channel, they watch Bloomberg, BBC, they understand what these anchors are talking about and why it matters. And so that's the point of it.
And give us maybe just one or two concepts that you think are important for people to understand right now. Maybe something we haven't discussed today so far.
Yeah. So, a lot of my concepts, they focus on the debt and the issue with the debt, right? So that's one of the things. But I think what's going on in Japan, that's very important. What Japan is doing and how they're manipulating their market so tremendously and negatively, that's really important to understand that. And that's something we've talked about quite a bit in online and in my newsletter. So that's one thing. Also, just really understanding how the system works. I have a lot of stuff in there that shows how the reverse repo works, how the treasury market works, how the treasury auctions work, and just understanding how all of what happened last spring with Silicon Valley Bank and how the bank reserves work and how all of that interplays in each other. And you hear all these acronyms and it's hard to make sense of them. But if you read this, it'll make sense. I promise you. It makes it easy for you.
I didn't have a chance to ask you, but you reminded me just now. We talked about the debt levels and the rising debt levels in the US in particular, and the problems that may cause and the inflation that may cause, but we haven't talked about the GDP side. Presumably, if your economy is growing sufficiently fast, you will be able to cover rising interest expenses, right? Is that what's happening right now, that our GDP is growing fast enough?
Yeah, no, it's not. It's
Okay.
not growing at the rate of the debt, and that's the problem. And that's why I fully expect for there to be a higher structural inflation than they admit to. And that way the GDP, the fake productivity, the nominal GDP will be higher than the real GDP, much higher.
Just narrowing down on inflation, and I'll let you go, James. This has been a great talk. Thank you. Inflation has been coming down. We talked about the BLS and how you think that may not be measuring inflation perfectly accurately, but let's just assume that these numbers are close enough to reality. Well, regardless of what you think the actual nominal level of inflation should be, the trend has been down. Right. So would you say that this trend is going to continue in the sense that we'll see lower inflation down the line?
Well, it really depends on just how much debt we have to issue, because the more debt we have to issue, the more inflation we need, and the less that they'll admit to it. So because as those deficits grow and the interest expense grows, you're going to need higher nominal GDP to pay for that. And so I expect, even though we're going to declare victory on inflation being somewhere around 2.5%, I believe it's going to be closer to 4, 5, 6% in reality.
Just to clarify, which has a bigger impact on the inflation rate, the debt level relative to GDP, let's say, or the deficit, which is expenses after tax revenues?
Yeah, running deficits is actually inflationary. You're pumping money into the market that you don't really have.
Right.
So
okay, perfect.
It has a large impact. It is inflation.
Okay. All right. Well, where can we follow your work? So you've got the newsletter. What's the URL to the newsletter?
Yeah, so you can just go to jameslavish.com. It's right there. And then we didn't talk about my work at the Bitcoin Opportunity Fund. We are focused on investing in Bitcoin companies, and this is important. And all of this stuff sounds terrible, and it sounds catastrophic. We're headed for catastrophe, but I am very confident and excited about the Bitcoin ecosystem and that space. I am extremely excited to be investing in there. I've got a great partner, David Foley. He has been working on Wall Street for just about as many years as I have. Very strong analyst and portfolio manager. He's a great partner, and we're finding some significant opportunities in the space. And so I want to reiterate, we are extremely excited about Bitcoin. So, and yeah.
How does your fund work? If you can give us some details, is it just Bitcoin? Are you involved in the miners? Are you involved in some layer 2 projects? Like, what do you look for your fund?
Yeah, that's a good question. So we're a public-private partnership. It is for accredited investors. That's the SEC's rule, not mine. But it's a public-private entity, and so we can invest anywhere in the space, but only in the Bitcoin space. It has to do with Bitcoin in some way, shape, or form. So yes, we are invested in some miners. We're very excited about some of the investments we have there. We are invested in some insurance products. We're invested in layer 2. We're looking at some hardware opportunities. We are invested in the public side. What's significant about our structure and why we did this is that we wanted to be able to take advantage of any opportunity anywhere, whether it's public or private. And we wanted to be able to layer in some risk management measures. And by being a public and private fund, we can do that. So we've got risk management over the top of the whole fund in the public space in order to manage the risk of the whole fund.
I'm just curious, are there any tax benefits to holding and trading Bitcoin because it's a commodity and not technically a security?
Well, it depends on where you live, right? So in our fund, it's taxed just the way the tax structure is no different for us.
All right, perfect. James, appreciate your time today. We'll follow up next time and talk more about Bitcoin and the miners and the ecosystem. Plenty to discuss there, but that was a very educational talk about debt and our structural problems. So thank you for your time today.
Yeah, thank you, Dave, for having me. I appreciate the questions, and see you next time.
Yeah, and don't forget to follow James. The links down below. Don't forget to like and subscribe. I'm David Lynn. See you next time.